Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending September 11th, 2020. For my members, subscribers, what you saw in the afternoon update on Friday is pretty much still relevant, and actually what I've pretty much been saying since Tuesday night is very little changed, but we'll go over a few things, and for everybody else, we'll take a look at the market. So this is QQQ, the NASDAQ 100's ETF. It is the second consecutive week down for the NASDAQ and the worst week since the March crash. The NASDAQ ended the week down 4.6%, and it came into the week Tuesday, remember, holiday shortened week, with another day down over here, making this the NASDAQ's fastest three-day correction from an all-time high, down 10% ever, down almost 11%. If we back up to the March crash, what you'll see is it took 6 days for the NASDAQ to lose more than 10%. So fastest three-day decline in the NASDAQ since the NASDAQ was established in 1978. In last weekend's video, I was talking about this channel in QQQ, the NASDAQ. So it fell again as of that video, of that last weekend's video over here on Tuesday. So wiped out over 3 weeks, 16 days of gains. And those were like euphoric rally, blow-off kind of rally type gains in 3 days alone. And the thing about this kind of move is people get upset, they get anxious, they want to know what's going on. But the fact of the matter is all of the hard work, and if you're a member of mine, you know, all the hard work was the weeks before. So when this happens, it's really just about managing the trade at that point. But a lot of people didn't see this coming because they weren't paying attention to what was happening back here. So we did short the NASDAQ. I closed that short Tuesday of this week. I started the short here at the top of the channel in QQQ on the 28th. And then I added to it near the close on the 2nd. And coming into this week, like I said, we got another down day, and I covered my short right here at the end of the day as the NASDAQ was coming down to the 50-day moving average. And we were looking for either a bounce, a correction, a consolidation, something like that. And you can see what happened here the rest of the week. Note the lower low in the NASDAQ S&P 2. And back here on the daily chart, I just want to show you the volume of this move. I mean, absolutely huge volume. You can see that coming on the way down over here. Here's a 15-minute chart, the S&P 500. It had its own channel. It wasn't quite the same as the NASDAQ's, but also big crack here. By the way, this level is the February closing high, where the NASDAQ, or where the S&P had some trouble. And the month of August, we saw just that euphoric rally through. In any case, down 2.5% on the week. Again, like I said, lower low over here on Friday. And small caps down 4.2%, and you can see a lower low over here too. We'll take a look at some daily charts in a minute. As far as S&P sectors, the energy sector, and this is a 30-minute chart of the energy sector, was the worst on the week, down 6.5%. You can see as it fell, has a little bearish consolidation here, fell again. This over here is the rotation to value and cyclicals that we had seen early in August, and then that failed, and they went back to what they know best, which is the mega caps. But this is a 4.5-month low, so this is really ugly price action in a cyclical in the energy sector. And these are the kinds of stocks, energy, financials, materials, industrials, that should be leading the market out of a recession. It shouldn't be one of the worst performing sectors or the worst performing. The second worst performing sector on the week was technology. So this is the technology sector, 15-minute chart, down 4.4%. And most of those FANG mega cap tech stocks were down at least 5%. The communication sector is also heavy with these FANGs. It was the third worst performing, down 3.25%. It's got stocks like Facebook and Google, and we can see a pretty significant trend line here broken as well. Closed near the low of the week. Again, lower low like we saw in the S&P, the NASDAQ, small caps. And then bringing up the rear, we had the financial sector down 2.3%, and regional banks really bad, down almost 6% on the week. Out of 11 S&P sectors, only one closed green for the week. That was materials, and it was only up 1%. It's the lightest weighted sector. It really doesn't have a lot of influence on the broader market. Now, what's really interesting for the worst week since the March crash is the fact that VIX really underperformed badly, down 12.6% on the week. And if you caught my last video, you know we were talking about the relative strength. This is what I was talking about early in the video, is people want to know, what's going on. The market's moved a lot, where the real actionable information was coming in over here. This is where I spent the most time doing posts and putting in a lot of hard work. By the time we get to the crash, that's kind of like the easy stuff. We're just managing trades at that point. where people who didn't see this stuff coming are kind of panicking and looking for information. But that information, really, the useful stuff, was right over here. So you can see early on in this decline for the market, volatility shot up really well. But this week, very weak. There's the 200-day moving average. There's the 50-day moving average. I think part of that is because traders felt like it was such a sharp, fast move down, and it was to some technical levels, like the S&P's 50-day here. I think they were just complacent and they weren't hedging. They were like, okay, it's fallen too fast. It's come to a technical level, and we're not really that worried about it. From what I've seen, doing a little reading towards the end of the week, it seems like the lotto ticket kind of calls, out of the money calls people have been buying during all this was very, very heavy again this week. A lot of speculative activity. So I think a lot of traders were just looking at this like, oh, it was a fluke, let's get back to what we were doing back over here. Complacency. So the VIX was down a little bit more than 12.5%, and NASDAQ, which was the worst performing on the week, its volatility gauge was down even more, about 15.5%. And if we look at the NASDAQ 100, again, I think it's the same reason. By Tuesday, we were here at the 50-day moving average, deeply oversold on a very short-term basis, a big, big sharp move, and I think traders just assumed, look, there's no more risk. There's no need to hedge, at least in part. Let's dig into a couple assets real quick. For members, I think even in last weekend's video, I talked about the dollar, the US dollar, and the risk that it poses that I think a lot of traders aren't aware of or not paying attention to. The US dollar and stocks have had an inverse relationship since March. So the dollar going down has been good for stocks, and the dollar's pretty much only gone down. But for the last 5 or 6 weeks, it looks to me like the dollar could see a correction, whether that be a rally or just a short squeeze. And I think a lot of traders, whether it be in stocks, commodities, even precious metals, are not aware of it, are not looking at that risk. So let's take a look at the dollar real quick. Here's a daily chart. You can see just it getting crushed since March, and stocks have gone the other direction. They've gone up. But what I've been showing is that the decline has been slowing down, and I drew this little trend line, and what we've started seeing is prices moving above that. So this is a potential change in trend. It's a change in character, and changes in character often precede changes in trends. Here's a little closer look on a 30-minute chart. So you can see the dollar creeping above this trend line, testing it a little bit, and so far holding up there. So if we do see a dollar short squeeze, I think that's another element that traders are not aware of. A lot of traders aren't aware of the risk that it poses to stocks. And with what's been going on with the stock market, people haven't been paying attention to crude oil. So we've been watching crude oil. Hasn't been doing a lot. It's been trading around like 43, 44. There's this very shallow trend line. The last couple weeks, it has gotten killed. It's broken down below that trend line. You can see 3C leading negative here on a daily chart. Here's a little closer view on a 60-minute chart of WTI crude futures, and here is that trend line break. So you can see stopped right there, support, and then just blew right through it. Let's take a look from USO's perspective. And this is a 60-minute chart, USO, the United States Oil Fund, and there's that trend line break. I haven't wanted to trade crude up in this area because it just hadn't been doing much and had been tracking real slow. But now that we have this trend line break, I am watching this very carefully for a fill of the gap. Maybe we get a bearish flag. It looks like price action might be starting to reflect that. It's a little too early to say yet, but this may be something on the radar as far as trades go in the coming week or two. Gold is a safe haven asset, but it's also very dollar sensitive. So if the dollar rallies, gold could get hit on that. But right now, gold is looking pretty good. It's doing a lot better job in consolidating a little bit more constructively. And here's a daily chart of GLD. Let me go up to a 60-minute. So you can see this kind of almost like a wedge or a big pennant, big triangle. And it started out very volatile. I don't like this kind of action here, this very volatile price action. And gold's volatility was up. It's still up. But the more it consolidates, the better it is. Volatility comes down. I would be looking at this, like I said to members earlier this week, maybe coming down over here. I don't want to take a lot of risk because of that dollar potential to rally. So I would rather buy down near this trend line, lower my risk, and then have a stop that I can place a couple percent below. Now, if the market tanks, gold could see a safe haven bid, even if the dollar does rally, but it makes it just a little bit more difficult. Gold miners are looking pretty good too. Here on a 60-minute chart, you can see a similar consolidation. It's like a bigger triangle. It's a little bit big for my taste. I like these small, tight consolidations, but it's doing the work and it's starting to come to an apex. We're probably about 3 or 4 weeks from coming to that apex. And here's silver, same thing. You know, it did the work over here, consolidated, nice, tight, small, bullish consolidations, rallies, but it just went too far here without consolidating. And now that's the price you pay. It has to take the time to consolidate. By the way, since we're talking about gold's volatility, here's where it just went up. Now, when this happens, price action just gets a lot more unpredictable. So I've been saying to members, I would like to see this come down below 20, which it's just starting to do now. That is a result of prices taking the time to consolidate constructively. As far as GBTC, which is the Bitcoin Trust, and I'm long here, we had a very nice consolidation over here, ascending triangle. This is about the 12,000 level for Bitcoin. So it's an area of resistance, and prices were chipping away at that supply, but we had a pretty decent drop here. And we still may have some more because the price action here has not quite stabilized. But I'm in this not for a trade, but for a longer term position, and I still like what it looks like. I'd prefer this didn't happen, but from that longer term perspective, this is the trend line I'm watching. This is the very bullish trend line. This is a breakout from a big triangle. Here it is on a weekly chart. Very constructive, huge triangle. This is years. That's how long it took to work off this huge volatility at the end of 2017 when Bitcoin just went parabolic. This is the breakout that we were just looking, and it's pulling back. So as long as it pulls back, and this is not uncommon, once you get a breakout from a major pattern like this, it's not uncommon to pull back and test that breakout area, which is basically what's happening now. So as long as it stays basically above this last pivot low over here, I am okay with this, and I would even buy more. Now, before I wrap this up, let's jump back to stocks, take a little bit closer look. Here is the SPY on a 30-minute 3C chart. So this is a longer term kind of trend. And we got that melt up in August. But remember, through July and August, we saw breadth just coming apart. It looked horrible. Even though the market was having this strong rally, all the internals were really falling apart. We can see the same thing in 3C here. This is August 3rd right here. So we can see the same thing happening after having this pretty solid trend. I usually don't use time frames this long because they're usually not that sensitive. But when we're looking at a longer term trend, you can really see here the confirmation and then things kind of falling apart under the hood in August. Here's a 1 minute chart. It was really QQQ that showed like selling distribution in 3C, a big negative divergence. That is what got me to add to my short right over here on the 2nd of September. SPY wasn't so bad until we got into this week. You can see 3C leading lower here. 3C is leading lower into this little bounce about Wednesday. And you can see what happened. Prices came down and 3C led prices lower to a new low for the week. Here we go on SPY's 5 minute chart. You can see it. So here's that lower low on Friday. That is not constructive price action. 3C was leading lower, suggesting this is a probability in the S&P. Now the Dow did make an equal low. And here's the Dow. You can see it held up right here at 27,500. So that's a little bit more constructive. But small caps, they made that lower low over here in Friday, and also NASDAQ. And here's that QQQ channel. And here is Tuesday, covered the short right there, and into Friday. I actually bought some calls late on Thursday, some weekly calls that expired the very next day. They were cheap for me. I told my members this is a risk I'm willing to take. All the premium is my risk, and it's a small speculative position. But what we did see was those mega caps really getting sold quietly under the hood. People probably didn't stand out to people because it's not like a crash, but they were being deleveraged more. These were the stocks that led on the way up. So we saw more deleveraging here. QQQ's 3C chart really suggested early in this week around Tuesday that we see more sideways action like this. This was the negative divergence I was talking about into the second. This is why I added to my QQQ short right here. And I got out of it right over here on Tuesday. 3C had a very small, minor positive divergence there. As we bounced, pretty good bounce on Wednesday. Look what's happening here, negative divergence. So we're seeing some selling into that bounce. It wasn't quite as bad as the SPY where 3C was leading lower by this point over here. So into Friday, again, a very small positive divergence in 3C. It's not the kind of thing that I would go out and say, look, there's a high probability buy based on this positive divergence. NQ, NASDAQ futures, showed the same kind of thing over here Friday. This is coming into the cash session, and you can see like a small positive divergence here, which prices lifted off of into the close. I think because it's a very important technical level. Here's the S&P's daily chart. That's the 50-day moving average, so tested right below it on Friday. and closed above it. I think that small divergence you were seeing was technical buyers here. Maybe some shorts covering, taking profits at the end of the week before the weekend. And here's NASDAQ 100. This is where I took my profits on my short on Tuesday, right at the end of the day as it hit this 50-day moving average. There's our little bounce that we saw some selling into. And here's Friday. So did close off the low, but just below that 50-day moving average. I don't think that's a huge deal, but there is some risk because of that lower low heading into next week. And small caps have been looking pretty bad over here. They really didn't do anything in August. I talked about that in the last video. After this initial rotation, everything went back. All the money went back to those mega caps. But you can see closing below its 50-day moving average. For members, what I said on Tuesday was that we have a very, very short-term oversold condition, and you need a bounce, which is a correction through price, or you need a consolidation, which is a correction through time, to work off that oversold condition. Here is just one look at it. This is the NASDAQ 100 in the green candlesticks, and in the white over here, this is the 13-week new high, new low ratio. We came into the week over here Tuesday at very oversold levels. This is pretty much just about as oversold as it's been through this entire rally off the March low. We got that little bounce Wednesday, but look where we ended the week, right back here, still in oversold territory down here below, like, say, 30. That's been kind of oversold on a short-term basis. So we are at those 50-day moving averages, technical support, with some very still deeply oversold conditions. I don't like shorting a market that is oversold like this. I don't chase prices down. I like to short into the highs over here when the market's overbought. And what I've been saying this week, ever since I covered that short on Tuesday in the NASDAQ, this is QQQ 15-minute chart, is that I would expect a back test of this channel and at least a fill of this gap from Tuesday. So this is how the market had ended that Friday, opened up Tuesday into the new week, holiday shortened week, and made a new low hitting that 50-day moving average. But I would expect, at least I would be looking for a back test of this channel, a filling of this gap. What I don't like about this price action as far as that scenario goes is the fact that it did make a lower low over here. That is not a good look to end the day or to end the week. And as I talked about before, the divergences, what you can see over here is that negative divergence into the highs, and the price is coming down and kind of more or less going sideways over here. 3C, if you look at the orange line, kind of more or less going sideways, and that's kind of what we see in prices here. Very choppy, very volatile, but going sideways. SPY was a little bit worse in that 3C was leading lower. Have a very small potential positive divergence here. This is not the kind of thing that I would be excited about buying, but I don't want to chase prices lower and short into a falling market. I want to short into price strength. So again, I would look for that gap fill up around that 284 level. The higher the better as far as getting in new shorts. Also, watch bond yields, what they're doing. Watch that relative performance in credit, whether it be high yield or investment grade, and watch the relative performance of volatility to whatever index it's applied to. So VIX for the S&P 500. One very interesting thing, despite that weakness in VIX and even VIX futures, the 3C chart of VXX has been pretty constructive. Here's VXX coming down into this week. You notice the positive divergence in 3C over here. This is the same kind of thing that we were seeing weeks ago before the market first started to crack. You can see it over here. Prices coming down or going sideways. 3C positively diverging over here. Same thing that we're seeing over here. So if we do get that bounce in the market averages, we get those gap fills, I will be looking anyway, at potentially buying volatility because it's pulling back. That means prices are cheaper for me to buy a long position, right? And into a positive divergence. As far as VIX itself, I think we're seeing a lot of complacency, but in this actual ETF, I think we're seeing some smart buyers coming in and hedging. So that will do it for this video. I hope you enjoyed it. If you did, please give it a thumbs up. Members, again, check out that afternoon update from Friday. I have kind of the particulars on those three things that I was talking about that I'll be looking for. That's the relative performance of volatility, of credit, and of yields. If you're not a member, check out the website. I have free posts. I put up a big free post about the middle of the week. And you can check out being a member. The link to the website is in the video description. And that will do it. Thanks, everybody. Have a great weekend.